Trillions of dollars move across the planet every single day. We spend decades of our lives working for it and chasing it, yet almost nobody stops to ask the most vital question: what are the actual mechanics behind the money in your wallet? Most people are taught a very clean story. Ancient humans traded 3 chickens for a goat, and eventually we invented coins to make that trade more efficient. Anthropologists have spent decades searching for evidence of these large-scale barter economies and come up entirely empty. The concept was actually popularized by Adam Smith in 1776 as a thought experiment, one he never actually observed. This is the scale of the current system. Total global debt has crossed $300 trillion, a number so massive it has effectively crushed the actual physical currency in circulation. The modern economy relies on a core paradox. The digits in your bank account are no longer printed to represent accumulated wealth. Instead, they are manufactured through the creation of debt. To understand why prices rise while wages stall, we have to look back at the original design for money and pinpoint the exact historical moment the entire system was flipped upside down. The actual history of money begins in ancient Sumeria, around 3000 BCE, with the world's first recorded economic system. Ancient farmers brought their excess crop yields to community temples for secure storage, moving their survival surplus into a centralized vault. Priests weighed the grain and issued a receipt. That clay tablet represented 40 bushels of barley sitting in the warehouse. That receipt was the money. This was a strict measurement. The tablet represented real, tangible calories that physically existed inside a vault. In this original paradigm, money was a direct consequence of productivity. It was impossible to have the currency without first creating real physical value. Jump forward to the European Middle Ages. Gold had become the standard store of value, but it was too heavy and dangerous for daily commerce. Citizens deposited their gold into secure vaults of goldsmiths. In exchange, the goldsmith issued paper receipts, recording transactions in a ledger like this one. Goldsmiths noticed a loophole. Less than 10% of depositors ever returned for their physical gold. Goldsmiths began writing extra paper receipts for gold that did not exist. They lent these receipts out to borrowers and charged interest on them. To the public, these notes looked identical to receipts backed by real gold. This specific practice is the birth of fractional reserve banking. This was the first inversion. Money was no longer a one-to-one measurement of physical assets. It became a multiplication system, backed solely by the probability that the public's inherent trust wouldn't suddenly break. In 1971, President Nixon ended the convertibility of the US dollar to gold. This action severed the final physical constraint on money. We entered the era of fiat currency, where money is backed solely by government decree. Today, money is created through a different mechanical reality. In 2014, the Bank of England published a paper stating that commercial banks create money whenever they issue a loan. When a bank approves a mortgage today, it does not move existing funds from its vault. It simply types new digital numbers into an account ledger. Every new dollar created this way is entered into the system as a simultaneous promise to pay it back. This means new money only enters the modern global economy when a person or government signs a contract to take on debt. The system has finally achieved a state of total inversion. Money is no longer born from an excess of productivity. It is created by the promise of a future deficit. We have moved from an ancient system that measured tangible surplus to a modern structure that multiplies abstract debt. The arrow has been completely flipped. This inverted system is not a mistake. It is the exact leverage mechanism that funded modern technological innovation and global trade at an unprecedented scale. However, there is a specific mathematical discrepancy in this design. While banks create the principal amount of a loan with a keystroke, they do not create the extra money required to pay the interest. The principal enters the economy, but the interest does not. Because the money to pay that interest does not mathematically exist in the system, the economy is forced to borrow more money every year just to prevent a systemic collapse. This perpetual requirement for new debt is the driver behind endless inflation and stagnant wages. The system requires constant growth to service the interest on money that was created as debt. The global economy is a mathematically inverted design, where every dollar in your wallet is merely the physical manifestation of someone else's unpayable debt.